Good morning, ladies and gentlemen, and welcome to the Modi Naturals Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akshay Modi, Joint Managing Director from Modi Naturals Limited. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. Thank you for joining us for the Modi Naturals Limited Q2 and H1 FY26 earnings conference call. I trust you have had an opportunity to review our financial results and investor presentation, both available on the company's website and on the stock exchanges. SGA, our investor relations advisor, is joining me on this call. The FMCG landscape in India today is undergoing a structural shift. Health, wellness, and premiumization are no longer niche themes. They are becoming standard expectations. Consumers are increasingly seeking brands that combine quality, purpose, and convenience. Meanwhile, regulatory changes such as GST rationalization have posed short-term challenges in pricing and inventory, but in the medium term, they create a more stable and transparent ecosystem for branded players. In the edible oils and food ingredients domain, the premiumization trend is particularly strong. With rising incomes, urbanization, and increasing penetration of e-commerce and modern trade, brands that offer differentiated value are winning. Our flagship brand, Olive, sits directly at this intersection, offering healthy positioning, differentiated formats, and premium appeal. The snacking ecosystem, too, is expanding rapidly, driven by younger demographics, online consumption, and shifting tastes. And this presents both opportunities and responsibilities. At Modi Naturals, we are well poised to capitalize on all of these trends. Moving on to our progress across our divisions. Consumer division. Our consumer division continues to demonstrate healthy momentum, anchored by strong brand equity and expanding product portfolio and consistent distribution improvements. Despite the temporary impact of GST rate rationalization during the quarter, the business has quickly absorbed the change and profitability is now stabilizing as expected. Demand across categories remains encouraging. Our expanded distribution network covering both general and modern trade, alongside a growing presence in quick commerce, continues to drive volume growth. The recent launch of our new product under the spice category has seen a good response, a positive response. This reinforces our ability to identify emerging consumer occasions and quickly innovate with differentiated offerings. Similarly, our pasta range continues to perform exceptionally well and consistently ranks among the top on a leading quick commerce platform, validating the product's quality and consumer acceptance. During H1 FY26, we made focused investment of rupees 6.3 crore in marketing and advertising to further strengthen brand visibility and enhance consumer engagement. These investments, combined with the GST-led transition, impacted quarterly profitability. However, they are strategic in nature and aimed at building long-term brand strength. Another encouraging trend in our deepening presence in Tier 2 and Tier 3 markets, where increasing product availability and stronger brand recall are helping us penetrate new households. This geographic expansion continues to be a key driver of growth and positions us well to capture rising demand across India's evolving consumption landscape. In H1 26, we have spent 9.15 crore in marketing and advertising. Bulk division. The bulk division has undergone a meaningful transformation as we shift towards a structurally stronger, more efficient operating model, i.e. a lower inventory business model which reduces working capital requirements, enhances operational efficiency, and supports better profitability. This strategic initiative has already started yielding tangible results. The bulk business delivered an EBITDA turnaround recording of rupees 1.2 crore in H1 FY26 compared to a loss of rupees 1.5 crore in the same period last year. The improvement is a direct outcome of tighter inventory management, more disciplined procurement planning, and improvement alignment between production cycles and market demand. Generally, Q2 is softer due to monsoon-related challenges, limited crop arrivals, and seasonally lower demand. However, with fresh crops arriving in Q3 and price normalization underway, we anticipate that the second half of the year will be materially stronger. Margins are also benefiting from favorable commodity prices and enhanced operational controls, and we expect this positive trend to continue as the new business model stabilizes further. Ethanol division. Our ethanol division, operated through our wholly owned subsidiary Modi Biotech Private Limited, continues to deliver a stellar performance, supported by favorable industry dynamics and internal operational improvements. With India's growing focus on biofuels and renewable energy, our ethanol business aligns perfectly with the country's long-term national agenda. We are not only operating a growth business, but we are also part of the future of clean energy. We have also secured substantial business visibility ahead of the next ESY, with 49,700 KL in orders, along with byproduct orders worth rupees 400 crore from OMCs in the October 25 Cycle 1 tender alone, and we expect further orders in subsequent tenders. One of our key strategic priorities, i.e. the major capacity expansion, is progressing well. The second phase of the 180 KL PD ethanol plant expansion is currently under trial and is expected to commence operations by December 25. Once completed, our total capacity will increase to 310 KL PD. Once our additional ethanol capacity becomes operational, we plan to participate in further rounds of tenders to fully utilize and absorb the expanded capacity. We will continue to update on the same as and when we make progress. With favorable policy support, a well-established supply chain, and strengthened operations, we believe the ethanol division is poised to remain a key growth engine for the company. Let me move to the financial section now. Coming to our consolidated financial performance. Q2 FY26 performance highlights. Revenue from operations is up by 0.3% to rupees 147 crore year-on-year. EBITDA for the quarter grew by 14.9% to rupees 15.3 crore year-on-year. EBITDA margins stood at 10.4%. PAT grew by 32.8% to rupees 10.1 crore year-on-year. H1 FY26 performance highlights. Revenue from operations is up by 2.7% to 302 crore year-on-year. EBITDA for the quarter grew by 24% to rupees 33 crore. EBITDA margins stood at 10.9%. PAT grew by 36.7% to rupees 20.6 crore on a year-on-year basis. Coming to our divisional performance. Consumer division revenue for Q2 FY26 stood at 46.3 crore compared to 46.6 crore in Q2 FY25, and H1 stood at 90.7 compared to 86.6 crore in H1 25. EBITDA for Q2 FY26 stood at rupees 3.3 crore as compared to rupees 4.6 crore in FY25, and for H1 FY26 stood at rupees 7.2 crore as compared to rupees 10.6 crore in FY26. Increase in advertising and marketing spend has had an impact on the EBITDA. Bulk division. In Q2 FY26, our revenue stood at rupees 16 crore as compared to rupees 19.6 crore in Q2 FY26. And H1 FY26 stood at rupees 47.2 crore as compared to 49.5 crore in H1 25. At rupees 40 lakhs in Q2 FY26 as compared to loss of rupees 30 lakhs in Q2 FY25. And in H1 FY26, EBITDA stood at rupees 1.2 crore as compared to loss of rupees 1.5 crore in H1 FY25. Turnaround in divisional performance in H1 FY26 due to change in leaner business model. Ethanol division. In Q2 FY26, our revenue stood at rupees 84.7 crore and for H1 26 stood at rupees 164.1 crore. EBITDA for Q2 FY26 stood at rupees 12.1 crore and for H1 FY26 stood at rupees 25.7 crore. EBITDA margin improved by 198 basis points to 14.3% on a year-on-year basis in Q2 FY26 and by 337 basis points to 15.6% in H1 FY26, driven by lower grain prices and improved raw material availability. The ethanol distillery currently operating at its optimum capacity. As we move into the second half of the year, we continue to demonstrate resilience, agility, and disciplined execution across all our business segments. Despite the temporary headwinds from GST transition and seasonal softness in the bulk division, our underlying fundamentals remain strong, supported by a healthy consumer business, improving operational metrics, and a high visibility order book in our ethanol division. We are confident of delivering a stronger performance in H2 and achieving our full year guidance. With this, we can now open the floor for question and answer.
Thank you so much, sir. Ladies and gentlemen, we'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Hanji. Next question comes from the line of Rohit Prakash from Marshall Malik Capital. Please go ahead.
Thank you for the opportunity. Thank you for the detailed commentary in the beginning. Just wanted to confirm that the expanded ethanol capacity will start in the next month. And how confident are we of filling the entire volume that is going to come up in the facility there?
Yes, we expect for that facility to start contributing to the revenue by next month, and we are fully confident of getting offtake of the entire volume.
Oh, okay. So I mean, it's not just commissioning, it will start so you see revenues from this facility in March quarter as well?
Yes, absolutely. We intend to, the trials are already started, and we intend to start production within December.
And we've gotten a contract also to supply, is it?
Yes, that's correct.
Okay. So on ethanol, this is confusion I continue to have. So this is again a personal research and including a personal issue that I faced. So this is so I have gone through a few mechanics in the city I stay in Bangalore, and this is general feedback that I've gotten that what is happening is that because of presence of ethanol with petrol, it is attracting certain kind of beetles in the country. I guess it's not an issue in Brazil, but perhaps it's an India-focused beetle or India biology issue, perhaps. But some insects and beetles are coming in and attracted to the smell of ethanol or something, and they are biting into the rubber hoses inside the engine, and it's causing leaks. And 3-4 mechanics I met in the city, they tell me that this particular issue ki wajah se they are getting 3-4 repair works in a week because of this from various vehicles. So any thoughts on this and how is this evolving? There's of course one talk of efficiency in terms of fuel efficiency, and then there is this issue that is at least I hear on the ground when I talk to the mechanics locally. So I just wanted to hear your thoughts on this if you have any.
Well, it's a policy matter, but all I can say is that a lot of scientific research has been done on this by ARAI and by CIAN, and I doubt that insects can really reach the inside of your engine and corrode the hoses. So I don't think that is a scientific claim. At the same time, most of the vehicles have been tested for this particular issue. So I think we should follow the policy commentary on this.
Understood. Thank you. And on the branded business, I understand the weakness due to GST, but would you be open to sharing the volume data over time? Let's say, so you have given historic 4-5-year revenue data, and it's great to see the revenue growth. But I guess we've discussed this before also that this is not the right indicator, because when oil prices go down, we show sometimes a degrowth or no growth, and hence we don't get the real picture of how well the business is done in terms of volume. So would you be willing to share the volume growth in the branded business, the oil specifically?
Sure. This is a call that the management will take, and we will share the volume data in due course.
Yeah, because the effort you're putting in marketing, etc., the only way an outside shareholder can see the progress is if the volume is growing. And we are not able to figure that out with the revenue numbers.
That point is well understood. However, so far the management has not been keen to share volume data. So once the management takes the decision on that, we will share the numbers. At the same time, please allow me to highlight that in Q2, while the revenue is flat, it's owing to the GST disruption in the last couple of weeks of the quarter. Yet, we have managed to maintain our revenue, which signifies that there may be significant underlying growth.
Yeah. So the point is well taken that you don't want to share the exact volume data. So one thing some companies do is that they give, let's say, 2020 index as 100, and then every year on that index of 100, they show the growth that is shown. So you're not seeing the volume data, but we get a sense of if the volumes are growing.
Fair point. Thank you.
Yeah. Thank you. That's it from me. Thank you so much. Yeah.
Thank you.
Thank you. Our next question comes from the line of Amit Agicha from HG Hawa and Company. Please go ahead.
Yeah. Good morning, and thank you for the opportunity. Congratulations for good set of numbers. So based on strong H1 performance, is there any upward revision to FY26 revenue EBITDA or PAT guidance?
I think we are well on track to achieve it. At the moment, there is no revision. However, as and when that happens, we will be announcing that as well.
And so what are the ROC and ROE levels that the management is expecting post-ethanol expansion?
We haven't done the math on that, so we will get back to you with that number, please.
Okay. Thank you, sir. All the best for the future.
Thank you.
Thank you so much. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Praveen Sharma, an individual investor. Please go ahead.
Hello, am I audible?
Yes, please go ahead.
Yeah. Hi. Good afternoon. Congratulations on, decent set of numbers. My first question is, on ethanol, first set of questions. First is, do we have long-term offtake agreement with OMCs for our both phases of the capacity, phase 1 and phase 2?
No, we do not have the LTOA.
Okay. So based on the tender which I have been seeing, I have read the tender also, so there is a recent, media reports wherein, as far as the food grain based ethanol is concerned, seems to be a overcapacity, because E20 is already achieved and it seems that capacity and production is more than what OMC said, offtake. And as per the tender, LTOA and, cooperative sugar mills will be, given preference, and after that, on a pro rata basis, they will be buying. So based on this, can you highlight as to or enlighten us that how do you see the capacity offtake of the production which we are doing both? Phase 1 orders are anyway there, 400 crores. Phase 2 is almost 1.5 times of phase 1. So how do you see in next 4 months and, in the new ethanol sugar year, subsequent 8 months for the next financial year, the entire capacity of 310 KLPD ethanol, the offtake of that?
So, as far as our capacity and orders are concerned, our existing facility can go up to roughly 320 crores. And the balance, we have already secured some orders for the first quarter or so for the expanded capacity. And in subsequent cycle tenders, let's say cycle 2, cycle 3, we will try and secure more orders for the full capacity going forward. So at the same time, your question around the overcapacity and all, I think it is a very regional and state-specific issue.
Correct.
So I think we
are so based on Chhattisgarh zone, whether it's a deficit zone or a surplus zone, so depending on that. But, going forward, if we take a 3-year view on the utilization, do you see more capacities coming up? And because E20 is more or less there, beyond that, it's going to be a substantial engineering change in the vehicle to go beyond E20. There will be new set of vehicles which will come, E100, complete ethanol, flex fuel and things like that. But, my worry is, my point is not worry because you are more connected and obviously you would have taken a due diligence and a, judicial call to go for the capacity expansion. How do we see the utilization in next 3-4 years of our entire 310? We should not land in a situation where our capacity is unutilized. That is the point I'm trying to understand.
Your points are valid. However, please do understand that, there's a significant inherent growth in India's fuel consumption. So YTD, I believe the motor spirit consumption has gone up by over 8% year on year. And if you add to that the 20% ethanol which has been blended, which was at, let's say, around 12 or 14% same time last year, we're looking at a growth of over 9% year-on-year. So that is a significant organic growth. And at the same time, I feel on a long-term basis, there are many other solutions available, consumption areas for ethanol. So blending itself can increase. Number two, the government is very keen on flex fuel engines. Once that comes in, those vehicles will consume 100% ethanol. And then there's also sustainable aviation fuel which is kicking in soon. So there's going to be multiple avenues for growth in ethanol consumption.
Just from my understanding, have they stopped giving further approvals for new plants?
Yes. So at the same time, the environment clearance fast track, which was available under B2 category for ethanol plants, dedicated ethanol plants, that has already had a sunset in March 24. So new plants will have to undergo the entire process of getting environment clearance, public hearing, etc. So I think that will pose a significant bottleneck to further capacity enhancements. And I believe the financial system is also taking cognizance of this fact.
Okay. So that's like ENA type of very stringent, public hearing, and it takes 3 years, 4 years to get environment.
So I think the capacity augmentation that had to happen has already happened in the country. And going forward now, I think it will be in increments.
Okay. And my next question is, for the projected revenue guidance, top line guidance of 850-880 crores for FY26, we have done around 300 crores for H1. So in the H2, do we see significant, more than 550 crores type of top line?
Yes, that's correct. So our bulk division contributes significantly in the second half of the year due to seasonality factors. And this year, we expect better performance from that segment, owing to volume as well as value growth. And consumer division will, of course, contribute to some growth, and ethanol division as well, once this plant gets commissioned next month, will contribute significantly to growth. So we are confident of achieving our set of numbers.
Great. That's very heartening to hear. Next question is if you can enlighten on the cycles of these tenders of ethanol. They typically happen in October, and the bulk of offtake is decided, or how does the cycle happen? Is there 2-3 cycles, or how does it happen?
I think every 2 to 3 months they come up with another tender for their increase in requirement, as well as for the drop-off that has happened in the period that has already gone. So, for example, if Cycle 2 tender comes out next month, or let's say in January, that will be for the balance part of the year, the growth that they are expecting, as well as for what has lapsed in the last 2 months. A lot of ethanol players, are taking large orders and not being able to supply. So that creates a shortfall as well in the system.
Okay. So that the bulk is done, planning is done in the beginning of the ESY, and then subsequently depending on the,
This year, I believe the last 2 quarters, they have held back some quantities to come out with tenders for the rest of the year.
Right. And how are the maize pricing? And the damage rate anyway is committed up to June, July, correct? The FCI price.
Yes, that's correct. So there's pressure on raw material on all 3 fronts. FCI has already earmarked about 5 million ton of grain being offered, and this is only for 9 months. For the last 3 months, they will take a call later in the year. And damaged grain, of course, is readily available. And both paddy crop as well as the maize crop is I think the highest ever. There's a huge acreage growth in maize as well as in paddy. So,
I hear that maize prices have also come down.
Yes, they are coming down.
Great. So that's quite heartening.
Thank you so much. I'm really sorry to interrupt you, sir, but you can rejoin the queue for more questions. Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next question comes from the line of Raj Shah from RK Family Office. Please go ahead.
Hello. So currently there are EBITDA is in ethanol is rupees 10 per liter, but other ethanol companies are reporting very much less. Maybe in our case, location is the advantage. Chhattisgarh is the reason for this. Now, with the government has increased MSP on maize from November, So what's your view on our ethanol margin? Because margin due to location advantage and change in government policy of increasing MSP price, both are somewhat negative or challenges our current EBITDA margins. So what's your view on this?
Well, we have options to switch to any raw material that we want and based on the availability. So we are confident of achieving a healthy EBITDA margin.
Okay. And sir, my next question is again like that overcapacity in the sector. And you have answered that fuel demand is growing and all that. But if we see region-wise, is Chhattisgarh a deficit region or a surplus region in terms of capacity?
I think most states are now surplus within the state, but there are many states which are deficit, and then therefore proximity to those states also makes a difference. So, for example, we can even supply to other deficit states like Tamil Nadu or Kerala, etc.
Okay. And you are confident that in the next, by the time next tender comes, we will be able to fulfill our whole capacity? Because in current tenders, like bidding was way than that was required. So and majority of the orders for this year are completed. Only minors are left. So with overcapacity and all that, are you confident that we will be able to fill our capacity?
Yeah, absolutely. I mean, there are some private OMCs as well, Reliance and Nayara. They offer the tenders as well. That's another 10% additional demand compared to the public sector OMCs. And we do believe that there has been some overbidding this year because plants were permitted to bid for 365 days a year, and we all know that plants don't operate for 365 days a year. So they can scratch off another roughly 10%. So I think the overcapacity problem is over-highlighted to some extent.
Okay. Thank you.
Thank you, sir. Our next question comes from the line of Ankit Minocha from Adezi Ventures Family Office. Please go ahead.
Yeah, hi, Akshay. I joined the call a little late. But firstly, on your EBITDA guidance for H2, I mean, considering we've done close to 33 crores in H1 and these fears about overcapacity in the sector, do we still feel confident that we can kind of do this 50 crore EBITDA number for H2 ahead, and what will be the drivers for this?
Yes, we are confident of achieving our set of numbers. As I explained on a couple of questions before yours, that we expect growth from all three divisions, and the bulk division as well contributes significantly in the second half of the year due to seasonality factor. So that will be coming in the next 2 quarters.
Okay. And post this, say, this utilization on H2, what kind of utilization levels are you looking for FY27? And I mean, what do you think could be growth drivers for EBITDA in FY27 beyond FY26?
So we have not given numbers for 27. However, I think with optimum capacity utilization in ethanol as well as growth from the consumer division, we do expect a decent and good set of numbers and growth in FY27 as well.
And in FY26, what would be the current utilization that you would see for the ethanol division if projections were to come through?
Well, for the existing capacity, we are at full capacity utilization. For the expansion, we are saying we will be commissioning in December. So let us see. Let's give it a quarter for it to stabilize before we are able to comment on numbers.
Okay. Thanks, and all the best.
Thank you.
Thank you. Our next question comes from the line of Amit Agicha from NJ Hawaiian Company. Please go ahead.
Hello. This is Faisal Hawa. Can you please tell us why the FMCG growth of our division is not very good at this point of time? And can you tell us the 3 steps we are taking to improve it?
Sure. Well, as I mentioned, in the last part of the quarter, there was a disruption caused due to the GST changes, and a lot of primary billings were affected due to that. Yet, I think we've had a flat quarter. We managed to not have a degrowth. And most FMCG companies, I think, in the sector, if you have come across, have had a similar issue. So if we factor that in, then I think we have had a decent growth. And the steps that we're taking, we've significantly increased our visibility in marketing. And also on new products, on other categories that we're focusing on. If you look at most of the e-commerce players now, we have started ranking very high on pasta as well. So we're focusing on other categories to deliver those.
And what is our advertising spend at this point of time? And can you give specific advertising spend that we are doing on the quick commerce platforms?
Well, the overall number is we've spent 9.15 crore for the 6 months compared to 6.4 crore last year. So it has gone up significantly, and that has also affected the EBITDA. And the growth that we were expecting in Q2 in top line would have mitigated this expense, but that didn't come because of the GST issue. So once that growth comes in Q3, Q4, that will get taken care of.
So roughly advertising expenses is around 10% of revenue.
That's correct. Yeah.
So no point raising that, ne?
Sorry?
There's no point raising that now because you are almost at the top end of the range. We can now only wait for the results to come.
That is kind of optimum. Let us wait for the results to come.
And do we have some kind of a target for like 4 or 5 years for the FMCG division?
Yes, of course. I've talked about it on many calls. We don't see any reason why this division should not get to about 500 crore number and contributing, from oil as well as foods. So that is our long-term vision.
And so far, have we put any funds from the ethanol division to the FMCG division for marketing and advertising expenses?
So we have not felt the need yet. Luckily, the consumer division is fairly profitable on its own and is able to fund its own growth at the moment.
And are we thinking of having some very high-end hires for sprucing our growth in FMCG division?
Could you please repeat that question?
Any high-end executives that we are wanting to take for getting our FMCG growth at much higher double-digit level?
Yes, absolutely. So we are constantly trying to build a good team, which we have, and we will be adding to that team in times to come.
Okay. Thank you very much for your time.
Thank you.
Thank you. Our next question comes from the line of Sandeep Dixit, an individual investor. Please go ahead.
Hi, can you hear me, sir?
Yes, we can.
Yes, please go ahead.
Okay. So I just wanted to understand the FMCG business a little bit better. Your EBITDA margins have been fluctuating quite widely for the last 4-5 quarters. Is there a particular reason for this? Is there advertising spend or is it the nature of the business?
Yes, I already explained that. I think on the last 2 or 3 questions, the same answer, that our advertising expense has increased significantly, roughly 30% for the 6 months. And this was a call that was taken in order to achieve faster growth in the consumer division. That is what has affected the EBITDA.
Okay. So I'm just looking at the numbers. So it's gone from 9%, 8% to 6% to 8.75 to 7.16. So, I mean, is this largely because of the advertising spend?
Yes, that's correct.
Okay, thank you. Second question is that you just mentioned a target of 500 crores for the FMCG business. Is there a time frame you have in mind?
It's hard to give forward-looking numbers, but I think on the previous question, Mr. Hawa had asked a particular timeline. So I think the comment was on that.
Sure. Thank you. That's my question.
Thank you. Our next question comes from the line of Ankit Minocha from Aditya Ventures Family Office. Please go ahead.
Yeah, hi. With the additional capacity that you have coming in for ethanol from December, what are the kind of additional operational costs that we might see on the P&L coming in for FY27? that will come in from the operate once this battery is operational?
I think in percentage terms it will go down because we will get operational leverage. So I don't think it will add incrementally in percentage terms.
Won't that be if in case the capacity is well utilized? I mean, if the capacity is, say, relatively not well utilized, then do we have a number in terms of 40 crores?
Even then in percentage terms it will come down because the way we had designed our plant, all the utilities are actually common, only the processing section is new. So therefore operating leverage will kick in as soon as the new plant is efficient.
So would it be a correct understanding then in that case to say that those costs should already be reflecting in your P&L and in your margins?
Yes, that's correct.
Okay. All right. Thanks a lot.
Thank you so much. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question comes from the line of Praveen Sharma, an individual investor. Please go ahead.
Thank you for taking my follow-up question. Actually, in the recent GST reform, the GST on pasta has been reduced from 12 to 5%, correct? And is there any reform on reduction on the edible oil range of products which we are actually selling?
No, it's the same.
Okay. So only pasta is. And can you enlighten, any new apart from moving forward from beans, what are our plans of new products? That is my last question.
So we do have a few products in the pipeline and we will announce them as and when they are ready.
Okay, great. Thank you.
I mean, just to give you an idea, we're looking at entering the ready-to-eat snacking segment as well. That should come out soon.
My just observation, I'm calling from Noida and the availability of people in quick commerce and big basket is a very big challenge also. So I was just wondering, this issue has been there and I've flagged it in earlier call also. I'm sure you would be taking corrective action. This was just a remark.
Sure, thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Participant comes from the line of Amit Akisha from HG Hawaiian Company. Please go ahead.
Yeah, so thank you for the follow-up opportunity. So what is the targeted debt equity ratio post expansion and what is the current debt equity ratio?
So I don't have the ratio in front of me, but I can give you the debt numbers. At the moment, we are, as of 30th September, we have a long-term debt of 125 crores and a short-term working capital debt of about 45 crores, a total of 170.
And so blended cost of interest on this?
We'll have to get back to you with that number. However, on the term loan side, we do have interest subvention, which is a 50% interest subvention, so our cost of is roughly 4.5%. And on working capital, we are at about 8.5%.
Thank you, sir. Thank you. All the best for the future.
Thank you.
Next question comes from the line of Rajesh Kaushik, an individual investor. Please go ahead.
Good afternoon. I'm just asking another question of the previous this one. The borrowings, do you have any plans? Can you just give me a bit of an idea of how you be handling the borrowings over the next maybe 1 year?
Your question is not clear. Could you please repeat your question?
Your borrowings. I'm looking at what I'm asking is, the long term. As per the last one, I see it's around 110. So what I was looking at, I was looking at how you intend to bring it down over the period of the next 1 year.
We're expecting strong internal accruals at the moment over the next 12 to 18 months. So that should take care of most of it, as we do have an option to pay them early. And at the same time, we do have the option to also raise some capital. But at the moment, I think we are fairly okay on the capital front.
Fine. Thanks. That's all.
Thank you so much. Ladies and gentlemen, that was the last question for today. I would like to hand the conference over to the management for the closing comments. Thank you, and over to you, sir.
Thank you. Thank you, everyone. I hope we have been able to answer all your questions satisfactorily. However, if you need any further clarification or want to know about the company, please contact SGA, our investor relations advisors. Thank you once again for taking the time to join us during this call today. Have a nice day.
Thank you so much, sir. On behalf of Modi Naturals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.